Hi guys, welcome to honeystocks.com weekend analysis for the 28th of September 2019. What a hell of a week, I think, for many of you out there. I put it out to social media late on Friday, just to my various channels, just asking if there was any charts that anybody would like a second opinion on. So thank you to those of you that replied, and naturally I've added the charts into the analysis. But if this is your first time maybe coming across my work, please do pause the video, make sure you're comfortable with that. It's basically saying if you have no clue what you're doing, if you don't understand technical analysis, do not act on any of these charts, don't act on any of the ideas, just discard everything I present to you in this video. Now, what I'm going to do is I'm going to present you with around, I think I've got about 22, 23 charts, talk about the overall market, as always, fully technical input. Most of you know that I don't do get-rich-quick schemes. I'm not interested in penny stocks. I'm not a day trader. My time horizon for trading is generally weeks, and in some cases months if we have a beautiful trend. And that's the approach that I've got to the market. I'm also registered with the CMT Association, working my way towards my chartered status at the moment. So I'm very much a technician. Technical analysis is my thing, and it's what I'm widely known for. Now, a lot of you will be finding yourself stepping in the brown stuff at the moment. I totally get it. I think every trader has been there at some point. So what I'm just going to do is I'm just going to walk you through the charts, and if you enjoy it, there should be a subscribe down in the bottom right hand corner there. So let's just get into it. So the first chart I'm really just going to talk about is the S&P 500. Now, rather than beat the drum and say to you, look, we're meeting resistance at a logical level of resistance, I'm not going to do that this week. What I want to highlight to you is that the S&P 500 is showing a lot of weakness at the moment. Now, what this indicator tells me is, it tells me the percentage of stocks within the S&P 500 that are currently trading above the 200 simple moving average. Now, what we can see here is we've got a pretty big decline. We've gone from 81% down to 66%. Now, what that really tells me is that there's not massive participation from a lot of the stocks within the S&P 500. Although we're very, very close to all-time highs, we're right there. We're knocking on the door, but we are seeing signs of weakness. Now, this is absolutely a concern. For those of you that maybe don't understand the full technical scope of the market, what you should be assessing with each chart, I think that this is pretty obvious. I think this would probably speak to most of you watching this. So with that in mind, we also have to consider that the small caps are just not participating. I think a lot of us over the last couple of weeks were hoping for a breakout in the small caps. It just hasn't materialized. And rather than sit at home and blame Trump, trade wars, can we not just view it as a rejection at key resistance? I think that's the logical way to look at it. I don't see the point in watching CNBC or Bloomberg all day. I couldn't think of anything worse looking at the news headlines, because price tells you absolutely everything that you need to know. You know when there's bad news because the price of a stock or the market will drop massively. So it actually pays to watch price rather than watch CNBC. It helps you to react quicker as well if you're maybe a short-term trader. So with that said, we need to get into the individual stocks and some of the sectors and maybe why we need to be a bit cautious with some of them. Like I said, a lot of these have been highlighted by you guys, so hopefully you get a bit of value from this. So iPay is the ETF for mobile payments companies, so you got PayPal, Visa, MasterCard, Square, but we're now showing a bit of distress here, bit of a breakdown that we're seeing. So what we would expect to see here is a correlation perhaps with some of the individual components within that ETF. Now, with PayPal, it's very, very clear we have a support level. The stock itself as a buy is absolutely no longer appealing, and I'll present you with some charts to show you that there are many better options out there. But you need to be super careful. I think if you break below $100, I think this is a big issue. And for those of you out there that are maybe looking to take puts or short the stock, I would suggest that that is a logical area to look. Obviously, do your own due diligence with every chart that I present to you, but that's how I see PayPal at the moment. Visa, definitely wouldn't advocate shorting. There's obviously a lot of strength with a lot of these companies still. We could absolutely see a rebound next week, but it does make a lot of sense to just watch these key areas, because if we see further weakness, again, that's not going to be good news for the mobile payments in general, and you could probably expect a lot of them to break down. Somebody was asking about Salesforce again this week. I don't see the attraction in the chart. I've talked about this one numerous times. I think until it breaks out here, it's just not appealing. It could be appealing if it comes down to the 135, 136 level. But at the moment, Salesforce is just, it's a horrible chart. Fundamentally, it might be great, but it's price that pays at the end of the day. So absolutely, it's not on the radar. Coupa Software is very, very close to breaking down. Given it another test today. Now, what we do know about stocks that continually test areas of support and resistance, eventually something usually gives. Now, we do have a very clear bearish divergence, so that's something to absolutely consider. And given that a lot of the cloud tech software stocks have fallen off a cliff, it makes sense to be super cautious with Coupa at the moment. AYX, I think somebody was asking about this earlier this week. What you have to understand, and what technical analysis does, and certainly does for me and obviously my client group, is it helps us to identify entries into the market. I think that's obvious. But if you don't know when to exit, then that becomes a problem, because what you're essentially doing is just giving up all your gains back to the market. Anybody that was in AYX for a long term, you should absolutely have been out somewhere around here. Trend has ended, move on. Now, the problem that we have now is we're starting to form, again, bearish characteristics. I think with this particular stock, I do think that this is the level to watch. I think if you break below $100, which is on the table at the moment, it's absolutely on the table. I think you do have a little bit of downside, but I would be watching that red line very, very closely. That's the 200-day simple moving average. But AYX, there's a lot of distress there. Now, Weight Watchers, most of you that follow me closely will already know that this is a stock that I presented a chart and a trade alert to my client group a few weeks ago. It's working out well at the moment for those that are still in the market. But I think we have to consider that there's potential institutional support here. In the face of a declining market this week, Weight Watchers has held up very, very well, and it's actually, I think it's probably closed higher than it did last week, which is just phenomenal. So Weight Watchers, if it's not on your radar, it makes sense to add it to your radar. Obviously, it's a complete lottery which direction stocks are going, but I think if you're super selective with your positions, not getting too aggressive, figuring out what works, what isn't working at the moment, then you can still profit, but you just have to keep the risk exposure I would suggest pretty low at the moment. Walmart, for those of you that are maybe in Walmart at the moment, maybe put the cautious hat on. Maybe some of you out there are in there maybe for the dividends, maybe a long-term hold, that's great. But what we do have here is, again, we've got a bearish divergence. So I think for those of you that are in Walmart, there is a logical expectation that you might see some kind of pullback. It's obviously held up very, very well in the current market. I think we're obviously seeing some of the household names hold up a little bit. And I think that maybe accounts for the first chart that I walked you through with the S&P 500, where we've obviously got a huge decline in the number of stocks trading above the 200 simple moving average. But that just tells me that everybody's gravitating towards the household names, and that's fine, that makes sense. But you also have to consider that generally happens. And for those of you that don't know this, that's a characteristic of something that we generally see before a bear market. Now, I'm not for 1 second suggesting that we're about to hit into a bear market. We're trading just below all-time highs. I'd be foolish to start calling a bear market. I'm just not one of those guys. But it does get you thinking, and it does make you consider, what if I'm wrong? You must always ask yourself, what if I am wrong on this? And that's something that I find serves me very, very well, and naturally serves my community and group very, very well. JP Morgan, somebody was asking about the banks. I think JP Morgan, I've been consistent on this chart. I think for the last couple of weeks on this breakout, I think you can be bullish above here. It's obviously done nothing for the last 2 weeks, but that's fine. There are hedge fund managers out there all across the world losing their minds at the moment. So I think this might be one of those that is holding up pretty well. You need to be super selective, but also understand where the danger areas are, work out the risk versus reward, and make sure that it fits maybe a trading plan and a rule set, which you should absolutely have. Activision Blizzard has had a bad week. I think what we have to consider here is it's a poster boy for Fibonacci at the moment. I think we've just met resistance at a Fibonacci level. It's coming back down. It's probably testing this one. So I think technically, for the individual that was asking, I think you can be bullish above this level and below it not so much. I think that kind of makes sense. Obviously, technical analysis doesn't give us a crystal ball into the future. We don't know when there's a tweet going out or when there's a news event that hits. But what technical analysis does do, it just helps us to work out, do you know what, let's just not hold on to this blindly. Let's not take a 20% drawdown. Let's just take a 1 or a 2% drawdown. I think that's what technical analysis does for most. Balzun. Now, first thing to say, there was 3 or 4 of you that were asking about this. The chart is disgusting. It doesn't meet any metric that I would consider for entry. But with that said, you asked for an analysis on it, and I think this is the chart of best fit. I'm not interested in stocks that just whipsaw. It's more of a style of trading that will benefit shorter term day trade swing traders in for a day or two and then out. That's not my game. But again, just talking about the danger zones, I think this is the level to watch here. What I would also say, and it's if we get another rebound on this, I think early next week, then it might potentially be offering entry for you. But I think the danger zone is definitely here. If you're out there and you're swing trading it, day trading it, or whatever, you can technically be bullish above this level, but it wouldn't be a trade that I would be looking to take. I much prefer charts like this. This is Absolutely my kind of chart. So excuse me. And yeah, I think PG just makes a lot of sense at the moment. It's trading beautifully. The trend is being respected. Why wouldn't you want to be in here? Oh, and that's hiccup started. Great. Now, Starbucks. Now, problem here with Starbucks is that we've formed a bit of a bullish flag. The geez. Hopefully I can get through this. So I think with Starbucks, we've obviously broken down here. Now that's obviously a bit of an issue for those of you that are out there maybe holding on. It's not a position that I would be looking to buy. I think that the trend has obviously been beautiful, for the last 12 months or so. But yeah, sometimes trends they just end, guys. It's heartbreaking, especially if it's a stock that's made you lots of money. But you just have to remember that you're only dating these stocks. You're never marrying them. As soon as you get married is the day that it'll take half, and you don't want that. So absolutely, if you're out there in Starbucks at the moment, I think the cautious hat definitely has to go on here. Gold has held up today. I think there was an expectation that we would come down and we would move into this level here again. Just pays to understand where the danger zones are, because if we get a breakdown here, that's going to have a knock-on effect to GDX, GDXJ, Kirkland Lake, Barrick Gold. All the gold companies, all the gold ETFs will have a bit of a problem. So you do need to be careful at the moment. I think, again, you can still be bullish gold above this level, but below it, I would expect a bit of a rapid descent. Shopify has found support this week. I think that this was a logical entry for those of you that may be taking it. So I think this is the level to watch with Shopify. Absolutely bullish above it. Below this support level, I think there's probably another at least, where are we there? 286 down to, yeah, so you've got a good $25 downside there. I think if you do break that level, then I think it just becomes a Fibonacci game, cat and mouse. But again, sometimes the trends they just end, guys. I think when you look at what it's done, it's been beautiful, but I would suggest that there's probably somewhere in here that you should have been exited out and just maximised the profits. Now, VRSK, I know nothing about the company, but the chart was built, so I've obviously done analysis on it before. This seems like a logical line of best fit. I think we've moved into the danger zone, and I think that's a problem. Again, sometimes trends just come to an end. I think somebody was commenting on Stock Twits that there's a fundamental issue with the company, and that makes sense as well. I understand that technicals and fundamentals play a role here, but if you're out there in VRSK, then I would suggest that you're in a bit of a you're going to have tough questions being asked. So yeah. Home Depot. I think Home Depot, you can still be bullish. It's one of those that's still working. There's not many out there, but like I said before, it's the household names are doing okay. Home Depot is one of those. So I think above 220, you can still be bullish. But again, below it, you're probably looking at a bit of a market meltdown if Home Depot drops below these levels. Bank of America. Again, we're very, very close to breaking out. Obviously, JP Morgan has broken out recently. Some of the financials are doing pretty well. I did note today that Goldman Sachs, I think, had a decent day, despite obviously a huge down day in the market. So absolutely, I think you can maybe set an alert for Bank of America, maybe at $30. I think if you get a breakout here, then it would make a lot of sense that it moves 10%. But, as always, do your own due diligence on it. Microsoft is hanging on in there. It continually keeps testing these danger levels, but it's very close to breaking out as well. Now, whether stocks like Microsoft, etc., are just masking the overall symptomatic issues of the market at the moment, that's a debate for another day. I think we just have to accept that there are stocks that are working, and this is one of them. So I'd be very, very closely watching this level here for a breakout. And likewise, if we get a confirmed breakdown here, then I think that's a problem for tech in general, given that there's a direct correlation, obviously, with XLK and the triple Q. So that's most of the information that I really wanted to kind of present to you this week. If you are somebody that struggles and you are somebody that has had maybe mixed success, maybe you don't understand technicals, you can maybe hang around for a couple of minutes. But if you did enjoy this, again, please subscribe to our YouTube channel. We do try to give some good content once or twice a week. It's not just charts. I do go into earnings strategies and September declines, etc. So yeah, hopefully you've got a bit of value from this. But like I said, if you are somebody that's struggling at the moment, just to maybe introduce myself, I'm Sam, and like I said before, I'm registered with the CMT Association, and technical analysis is my thing. I also run honeystocks.com trading school. It's very technically driven. Like I said before, I'm not interested in penny stocks or get rich quick schemes or day trading. It's just not what I do, and I really set myself apart, and I do not associate with any of the guys that I suppose throw out forex signals and day trading signals. I think it's all nonsense, and I think it's all bullshit. So yeah, if you're somebody that is struggling, then feel free to go and check out our website. Now, the one thing that you do need to understand is that, I can't help everybody. I think if you are looking to maybe fit trading around a career or a business, if you're trying to move away from day trading, I can probably help. Maybe you want better consistency, and maybe you want to learn and not just follow, then I can probably help you in some way. I do make it very easy to get in touch with us. But I think the one thing that I understand is that in order to be successful, you need to be an independent thinker. You need to have your own unique rule set, and that's something that I will help you with. Now, the one thing that I think sets me apart from anybody else that does what I do is everybody that goes through and learns with us, we integrate them automatically into our group community for life, and I publish every single chart that I produce and send out to my group, and we've got a very quality over quantity approach. I'm not sending out 3-4 trade alerts a day. Again, I couldn't think of anything worse, but when I have a high conviction idea that I feel like warrants a lot of due diligence, I'll send it out. So you can go and check 2019. 2018 is there as well. I'm not for 1 second saying that 1400% returns are achievable, because they're absolutely not. What you have to understand is that at any one time, there's only a set amount of positions that you can have open, but these are all the charts that I have supported my group with over the last couple of years. And, if those kind of stocks are the kind of stocks that you like to trade, or they meet your requirements, then feel free to scrutinize that. But I do understand that if you're out there and you're maybe learning from losses, especially at the moment, I totally get it. I completely understand how soul destroying it is, and how much it can impact not just your trading, but your home life, your career, maybe your business. family. It has a wider impact. So if you're learning from losses, or maybe you're just trying to muddle through all the YouTube videos, etc., we can probably accelerate your learning curve quite substantially, because I think Wall Street at the moment is swallowing a lot of you into a big black hole, and that's just the harsh reality of the current environment. But at honeystocks.com, we genuinely believe in making a difference. You can go onto our website, check out all our testimonials, real people, and we have made a massive impact. So, do you want to continue doing it the current way, or are you open to maybe learning a new way that's built on logic, structure, and a lot less stress? And that's really what I can offer. I do make it very, very easy to get in touch. You can jump onto our website, like I said, honeystocks.com. Just click on join, and all you need to do is tell me as much information about your trading journey as you can. I think the one thing that I do understand is that when I jump on a call with somebody, I'm not trying to shove something down your throat, trying to make you sign up for a program that you don't want to sign up for. I think I just genuinely love helping people. I've had hundreds and hundreds of conversations with disgruntled, disillusioned traders all across the world at this point. So if you're out there and you're somebody that does struggle, maybe you would just like to talk to somebody about the technical side of the market, feel free to absolutely do that. The calendar is going to be open for the next 3 days. Over the weekend, it's fully open. So if you want to talk to me tomorrow, Sunday, maybe Monday, then there's going to be a facility for you to do that. Just go on, just select a time. Like I said, it's super informal, super chilled conversation, and hopefully you get some insight from it. But if you've stuck around to the very end, thank you very much for watching, and apologies for the hiccups halfway through there. But yeah, hopefully I'll speak to you soon. Thanks.